Before we move ahead,
Yeah.
if you can just go back to that slide, Prabhakar.
Yes. Yeah.
So, as you mentioned that you will probably come in when there is a positive surprise.
Correct.
So, are you going to cover that in your subsequent slide? When do you get out? Or
yes. I will
okay.
cover that.
Then I'll reserve my question. Yeah, you can go ahead. Okay.
Yes. If anybody has any questions, they can please put it in the chat, and maybe Ankit can ask the questions for you, or we can do the questions post the presentation also.
Yeah, you can continue. I'll come in between whenever required.
Sure. So now let's get into the a little bit of the meat of the thing. So what really is an earning surprise, and what are the different conditions? Because what I showed you earlier was a quick overview. I did not go deep into the details of what really you have to look for. But basically, if I have to list out the various factors, then these are the various factors that you have to look out for, right? So number one, that is the only factor we looked at, that there has to be a massive sales or operating profit beat, right? So there has to be a massive improvement in the top line or the operating profit or both, right? And when I say massive, the massive is subjective. Everything in the stock market is subjective, right? So a company that is a very slow growing company, if it starts giving you 10-15% earnings growth, which was earlier growing at single digit, then that's massive for that company. You cannot expect a company like Hindustan Lever to grow at 30-40% top line. For Hindustan Lever, even a 15-16% top line is a massive beat. So the massive has to be seen in the context, right? So there has to be a massive beat, and there has to be an acceleration in the numbers. So when I say acceleration in the numbers, there has to be the growth rate. So let's say you bought it on the first earnings beat. For the move to continue, the growth has to continue. If it is a 1 quarter wonder, a lot of companies here will be 1 quarter wonders. So if the growth has to continue to accelerate, so if the first surprise was a 10% surprise, the next surprise has to be higher than a 10% surprise. So these are the best case scenarios I'm telling you. All of this may not happen all the time, but if you want the best of the best setups, then there has to be a massive beat and there has to be an acceleration in the subsequent quarters. The third thing is market reaction. A lot of times we have to look at the market reaction, especially in bull markets. In bear markets, it's difficult to gauge the reaction, because like we saw in the case of ITC, after the results, the stock actually fell before going up again. So, but in case of a bull market, the market is good, then you expect the market to react positively. So your analysis and the market's analysis has to match, right? Especially in a bull market. If you feel that it's a blockbuster earning, but the market is not at all reacting to it, then you have to take a step back and reassess, right? The fourth condition is neglect. So you ideally want a stock that is neglected. Like I showed you in case of ITC, the stock had gone nowhere for the last 3 to 6 months. So ideally, before this earnings surprise, you want to see price neglect. You want to see analyst neglect. You want to see neglect in any form is good, because that means that there is no froth in the stock, and there is enough upside left for us to participate. And of course, limited analyst coverage. This is important more for the mid and small caps, and like I showed you, it works for the large caps also, even where there is an analyst coverage. But limited analyst coverage is better, and obviously it will work much better for the mid and small caps than for the large caps, because large caps are much more well covered by the community. So the surprise element typically is lower there. So, but in a mid and small cap, the surprise element generally is much higher. So it will work much better in a mid and small cap universe. So let's sort of break down, each of these. So like I said, when I say massive beat, it has to be a revenue margin operating profit beat. And ideally, the most important point here is that you want to get in the first quarter or the second quarter of the beat. You don't want to get in post that. There is no point in getting in late in the setup. You either have to get into first quarter or the second quarter, right? Like I said, acceleration. Acceleration means